Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include trade-related uncertainty, my interview with Jeremy Potter and Brian Levy on how the conforming credit box that once offered liquidity to the mortgage market is now fading into obsolescence with the rise of products like non-QM and other creative lending solutions. And since we received a benign CPI report yesterday, let's see what PPI has to bring today. Today's podcast is presented by Fly Homes, the leading wholesale lender focused on exclusively buy before you sell solutions. They empower loan officers and agents across the country to help their home buyers purchase their next home before selling their current one, eliminating the hurdle of sales contingencies, double moves, and financial roadblocks. Whether your borrowers run into DTI issues, need to unlock home equity for down payment, make a stronger cash-like offer, or even move potentially with no cash out of pocket, Fly Homes provides a full suite of financial products to help them move forward confidently before selling their current home. I was always a home builder, but lately I've developed an apartment complex. Where I was in Florida yesterday, I actually got delayed due to thunderstorms in the afternoon on my connection through Phoenix. They canceled my flight until the morning. I decided to rent a car at 10 p.m. in Phoenix and drive 6 hours for you and 4 hours for me to San Diego, where I am this morning. But in Florida, so many structures are made of stucco because stucco is fairly inexpensive, creates a great finished look, and is easy to apply to homes constructed with concrete blocks. But it can be damaged as the house shifts and settles over time. We're seeing new methods arise, such as 3D printing. The method is largely used to construct walls, while conventional methods are used for foundations, floors, roofs, and finishes. Yes, things are always evolving, and I think it might be worth bringing to your attention that Fairway Independent announced yesterday that it had purchased the mortgage branches of Hallmark, an Indiana-based retail lender that did $600 million in production last year. Hallmark Home Mortgage, powered by Fairway, will be a new division of Fairway and will add to Fairway's $23 billion in retail volume. But that wasn't necessarily the main headline yesterday. Inflation data for May that was released yesterday came in softer than expected, providing a degree of relief to markets and increasing the likelihood of future interest rate cuts by the Federal Reserve. This prompted a positive reaction in the bond market, with short-term yields falling and investors turning their attention to next week's Federal Open Market Committee meeting for further direction. However, while the current data appears benign, it may not fully capture the underlying risks tied to ongoing trade tensions, particularly as certain tariffs are set to resume when current 90-day pauses expire later this summer. Trade-related uncertainty remains a major concern for investors. Although recent talks between the U.S. and China resulted in a tentative framework to resume a previous truce, markets reacted cautiously, seeing little tangible progress. The situation is further complicated by a federal court decision allowing President Trump's tariffs to remain in place pending appeal, extending a period of policy limbo. Many expect the president to prolong the current pauses, which, while softening immediate inflation risks, prolong market uncertainty. The practical implications of tariffs on end-user prices, particularly in sectors like autos, remain a key area of focus for the coming months. As such, the full economic impact may not materialize until the second half of 2025 or later, raising questions about the sustainability of growth if trade policy continues to shift unpredictably. At the same time, President Trump has intensified his call for a full-point Fed rate cut, arguing that lower rates would ease government borrowing costs amid mounting national debt. However, the Fed continues to prioritize inflation control and employment stability, resisting political pressure to act prematurely. With inflation modestly higher year over year and tariff-related costs still looming, economists remain split on whether current conditions justify easing. Some expect a September rate cut as inflation shows signs of cooling, while others warn that price pressures could reemerge if tariffs escalate. In this uncertain environment, market participants are looking closely for more concrete policy decisions from both the Fed and the White House that could set the tone for economic momentum through the end of the year. For today's interview, I want to welcome back to the show Jeremy Potter and Brian Levy to talk about how the conforming credit box that once offered liquidity to the mortgage market is now fading into obsolescence with the rise of products like non-QM and other creative lending solutions. Something tells me both of them have been waiting for a moment in life where the host says they need no introduction. So I'm going to say it. They need no introduction.
Generally speaking, kind of the path of Fannie and Freddie and where they were, where they are, where they're going. And some would argue, I think I think you and me are in a similar camp that Fannie and Freddie have been so important in providing liquidity and functionality to the mortgage market. And yet with, Pulte in charge of the FHFA or Trump's directives, the reprivatization, those sorts of things, it's almost this like slow fade from prominence or slow fade from what it seems like they were designed to do for the finance housing system. I think that's where your head kind of goes too with what you've seen, or are we viewing it in a slightly different way?
No, I mean, I think you're describing it very accurately, at least in terms of what I was positing in my musing. I don't know how to measure the value of that liquidity. Like I said, it's obviously important to financial markets to have liquidity. Makes things a lot easier. I use the example of trying to trade mortgages out of, boxes and what you got, start that conversation as opposed to having a standardized set of underwriting criteria and loans that meet whatever the credit box is for the investor. So I think it's valuable, but where do we go from here? I don't know.
Well,
If
maybe
you
we'll couch it this way because we missed Now Next Later this week because Jeremy was traveling and Sasha was at a conference. Jeremy, when we think of Fannie and Freddie now versus next versus later, let's maybe have that sort of discussion. Where do you view them now? And not what they were a couple years ago or a decade ago. Right now it seems like they've, I've said on this podcast before, I've heard anecdotally, they're winning less and less business. Jenny has stepped in and filled some sort of gap. There's been this proliferation of the non-QM space. And it's almost like the powers that be are okay with that for Fannie and Freddie. So when you look at Fannie and Freddie now, June 2025, where do you see them?
Yeah, I'll answer your question in two ways. One, I think that the efforts over the last few years have brought us to a position right now where they are more alike than ever before. They've standardized the universal mortgage-backed security, the UMBS, so they have this uniform way of putting their product into a security. They've been standardized in a lot of credit guidelines and other kind of practical ways for lenders. They've been standardized across servicing so that their servicing guidelines are relatively standard. So as we stand today, they look more like each other and the same thing than ever before. So the key question that you put out there around what is Pulte and the Trump administration thinking, I think they're thinking, how do we get these two competing again? Separate from exit. I think on the way to exit or as part of exit, it's kind of all wrapped up in the same strategic question. But right now, they are almost identical. And then you have to kind of look back at history and say they weren't meant to be identical. They were meant to look similar. But that, I think, is one of the key questions for the Trump administration on GSE reform. The second thing I'll say,
go ahead,
Brian.
No, I was just saying, but wouldn't it be easier to compete if they aren't regulated by the same regulator? I mean, if they're no longer under the thumb of the government and, if they really want them to compete, I don't know, why they really, unless they think that that's somehow going to make the housing finance market better. My sense is the Trump is really not all that concerned about a policy issue, what's best for housing policy, but more like what's the best way to raise money for the government that I can spend.
I think there's two. The thing that comes to mind first, Brian, is you can actually have them compete on the way to exit or totally separate from exit, meaning the same regulator can still regulate them in the way that the OCC will regulate two competing banks that are probably pretty similar because they're giant national banks, but also are doing different things and are regulated differently. And I think that's how they're thinking about it. If I had to guess, they're thinking about it like, hey, prudential regulators do this all day, every day with competing banks. Why can't FHFA also treat these two like that? I think the question—
Because there's only two. That's
there's only two. That's the key. Yeah. But I think the question you asked earlier is how would you measure if they were losing some advantage or some other aspect of their personalities as quasi-government entities? And the way that popped into my mind, my former capital markets brain working overtime there, was actually we're seeing pricing look a lot more like non-agency pricing. So as you see, it used to be really far apart. Used to be, I'm talking a few years ago, right? 4 or 5 years ago, that pricing between agency and non-agency pricing, very, very different. Now it's actually starting to close, and it seems to be on a trend line to continue to close. So if you were measuring it from simply a capital markets pricing perspective, I think your theory is correct that they must be losing something relative to their unique position for liquidity if private capital has started to close that gap. However, it has not closed that gap truly. And so as a result, they still have the dominant position for pricing standardization and liquidity.
It almost makes me think that Fannie and Freddie, or the people that work within Fannie and Freddie, deserve some sort of opportunity to now reestablish themselves versus being, for lack of a better term, gutted entities. Like let them be privatized so they can now start competing again on their own. Granted, with the added bonus of having some backing, whether that's implicit or explicit. It's likely going to be implicit, in my opinion. But I would think that at this point they've been so sidelined in a way that they deserve being able to now compete again in a manner where the government doesn't have some vested agenda for them. I don't want to say vested interest. It's almost a vested agenda for them. Brian, you get that sense?
Yeah, no, I completely agree with that. The agenda, of the Biden administration was, a DEI based agenda. It was equity and not profits necessarily, and not, competing. That was I think a sidetrack that they got off on, and need to get back into competition like Jeremy suggests. I think there's some tremendous value in there, institutional knowledge about how to make loans, how to be an investor, how to price loans. I mean, there's just there's a tremendous market that they can dominate, even if they aren't, getting a federal guarantee for what they're doing.
Yeah, I think so too, Brian. I think that what I found fun and fascinating about the Biden administration approach was, can we use these to create opportunities for home ownership or other types of, residential home equity that don't increase risk to the system, but actually still promote economic activity, and especially among new first-time homebuyers? That is a question the private market is not handling well, right? So when you think about big picture, why give these entities charters and why give them an implicit guarantee? One reason is to backstop a private market that's not filling certain gaps. And I felt like if you left first-time homebuyer risk, and I put that in air quotes, if you leave first-time homebuyer risk to the private markets, I think you're going to find that there's fewer and fewer opportunities for first-time homebuyers writ large. And it was and is interesting to see the GSEs think about that. And so I think the people within the GSEs, Fannie and Freddie, prior administration, current administration, want to see more home ownership as a rule, want to see it as a trend among generations of Americans. The question is, how do you accomplish it with the constraints as they exist today? And, we can talk about credit guidelines, but I think there's a variety of ways that they're not looking at that they could look at, which don't introduce a ton of new risk, but introduce new opportunities. We saw it in one way, or really trying to focus the resources in one way during the previous administration. Now we're seeing it in a couple other ways in the new administration, but I still think it's an achievable goal for these two entities, and it's still innovation. Could be.
Well, I would almost think that the non-QM space or guidelines or programs have pushed these two companies to where they have to look at the writing on the wall or reevaluate things. And Grant, as a sidebar, we could have a discussion about what happened in March of 2020 when non-QM's liquidity drying up. Could that happen again after all the progress that it's made? I feel like that's a discussion for a different day.
Well, can I just do a quick Brian Levy footnote?
Sure.
Because the footnotes on the Mortgage Musings are some of my favorite part. And the footnote here would be, a lot of the non-agency product is actually QM caliber credit, but it is priced as non-agency, non-QM because of the liquidity risk, not the credit risk. These are good loans in the qualified mortgage.
That would almost argue for Fannie and Freddie getting out of government conservatorship, so that then investors are forced to price these in a common sense fashion.
I do think that is one of the outcomes that could, I think that means prices will go sort of more towards private capital prices for first-time homebuyers, but I think the credit guidelines will be more dynamic and it might offer them more opportunities, even if it's a slightly higher rate.
I'm just talking about Fannie and Freddie starting to realize that we need to qualify income in a more modern fashion. Like, what will actually force them to get to that point? Because that's almost that is the crux of what we're talking about today a little bit, is when Fannie and Freddie, sure, they'll be reduced into something, and then they're going to rise from the ashes like a phoenix back into what you would hope these things to be incorporated. Brian, I'm sure you have plenty of things you'd like to say to what Jeremy and I have said.
Well, I want to make sure I understood Jeremy correctly, that there was the concern around if you release Fannie and Freddie, does that actually lower first-time homebuyer opportunities in the marketplace? And I'd be surprised if that actually was the case. I think what you're going to see is you get out of this credit box that only exists because Fannie and Freddie created it and enforce it for the liquidity purposes, maybe because to justify giving a federal guarantee. But if you can do loans legally, anybody in the private sector can do loans that are as long as they meet the ability to repay standard. They don't have to be QM. They just have to meet the ability to repay standard. Opens up the possibility for doing underwriting in completely different ways. We're not just talking about income qualification, how you qualify the income. You're talking about why you approve somebody for a loan. Very curious to see how the market might react to that. Now, we have non-QM today, but we also have Fannie and Freddie in such a dominant position in FHA as well. It's hard to move outside of that. So I was curious if you really believe that, or if you think maybe this is an opportunity, maybe you just don't know. I don't.
No, I think what I was saying is that I would understand shareholders of the GSEs in their post-exit structure, as well as private capital, to kind of look more and more alike. And the problem with private capital when it comes to serving first-time homebuyer needs is it's very finicky. It's very fickle. It's in and out at a moment's notice. And so the one thing that Fannie and Freddie should offer and have offered, they were created to offer, is a little bit of a normalizing effect in the market, so that if private capital is immediately skittish over first-time homebuyers for some reason, some economic event or some other thing, that somebody's there to keep that credit mildly stable while the market works through whatever the event is. And so we have seen, to Robbie's point about non-QM earlier, we've seen liquidity dry up for a variety of reasons. And, we can kind of posit what those might be in the future. But I was just saying, I think that there is a opportunity here. If what you're worried about is credit risk, there's actually a good investment in first-time homebuyer credit risk right now. Even outside of Fannie and Freddie, the way Brian was just talking about, but I'm saying just in general, and it doesn't get priced to the credit risk because of the liquidity crunch. And so you have to balance both, obviously, but that's what I was saying, is if you were just looking at credit risk, there are really good loans out there that aren't being made. And if you ask why they cost so much to make or why they're not being made, it tends to be liquidity risk, nothing to do with actual credit risk.
Let me come in with the free market economist angle here. And I would argue that whatever private capital is willing to price loans at is fair. How much government intervention is, needed? In an extreme case, you look at like the Communist Party, currency manipulation, artificially stoking, the Chinese economy through, stimulus measures and stuff. You could argue that's good and that's beneficial. Maybe the U.S. has found a perfect little medium with Fannie and Freddie of supporting the largest housing market in the world, and it's allowed America to flourish as a country. Or maybe you argue that time is gone, and now it's up to free market capital to put its money where it's worth. And if they want to price first-time homebuyers high, so be it. That's the natural course of economics. And Jeremy doesn't really like what I'm saying.
Well, and I do too.
I'll let you go first.
I was just going to talk about housing policy. I mean, and Fannie and Freddie have been just the most important part of housing finance policy in this country for 50 some years. We made a decision. Congress made a decision to put them in place to support the housing market because that was good housing policy that the people in the 1960s and 70s thought would be good. We've now had them in conservatorship for 17 years. Nobody's making any decisions in terms of Congress and thinking about housing policy. But what you raise is critically important, Robbie, because we do have these things in place and we don't have any coherent policy around why.
And Jeremy, let me quickly say, we're arguably no closer now, 5 months after inauguration, to any clarity on what way we're going with Fannie and Freddie than we were, January 10th.
Well, I think if you go even before that, Robbie, there was a notion that we might be in conservatorship forever, right? It's just a never-ending conservatorship. And now what you're saying is there's a similar lack of clarity, but in a more sort of it could happen at any time or not sense of that. And so I do think if you were asking me, are we closer to exit with this administration saying, I want to exit at some point, then the answer is obviously yes, because we're closer than we were with a never-ending conservatorship. But if the question is then, how do they get there in a way that doesn't disrupt what Brian's saying, which is what we're used to? It seems unlikely there's a path to exit without disruption to what we're used to.
Closer,
So
to my opinion, we're closer to a mess. We're closer to a mess because once the midterms hit, I don't think it's going to be a red wave controlling anymore. And it's almost like the Trump administration had this 2-year window to really do something. And by wasting 6 months, we'd all knew it was going to be a process. Anyway, a lengthy process. By wasting 6 months, I don't think they're going to get anything done before midterms. And subsequently, I think that Fannie and Freddie are just going to be stuck in this no man's land between where they were and where the Trump administration would like them to go.
And I do think that's a popular view, meaning I've heard that as well. I just think that if you are creating a goal to have them exit, you can find a path to exit before or after the midterms if you really want to, but it's going to come down to what you just said. How hard do you want to just force the issue? And what I'm saying is, it seems that there is a motivation to do that, but it's going to be impossible to do without a major disruption to what we're all talking about here.
Completely screw over first-time home buyers, jack up interest rates if they want to rush it. Yes, Brian, but you've been on the sidelines here. Please chime in.
No, I agree with what you guys are saying entirely. I worry that what will inspire the change that you're suggesting, or at least the assessment that is needed, is a crisis. An actual crisis, not one of these crises that everyone says, we have a crisis of this, a crisis of that, No, I mean, like COVID was a crisis. COVID was an event that we couldn't control. Now we've got, serious problems with affordability of housing right now. Kind of see how this plays out, but
I couldn't agree more, Brian. I'll add this. I've been using this metaphor a lot, take it or leave it if you like it or not, but preventative care versus urgent care. It doesn't matter what industry you're in. Our industry is the same as many other human industries, which is we're not good at preventative care. We're not good at investing ahead to avoid pain and suffering down the road. We're not good at it in healthcare, and we're not good at it in financial services. And the mortgage industry is no exception. So we could be doing a lot more around a crisis with a generation of people who are not economically viable to buy the products and services that we want to create, but we're not doing that preventative care right now. And so as a result, there will be a need for urgent care at some point because we're not creating a situation where we're going to have a wave of people who can afford our products.
Our government has never liked preventative care. Otherwise, we wouldn't have so many processed foods and weird gluten all those things when it comes to like Western anyways, I don't want to draw that parallel. I want to be a good moderator. I want to be a good moderator here and kind of, rather than us three being talking heads, get to some sort of bow on this conversation. But I'd like to keep this to a 30-minute discussion or less. Obviously, we could talk for hours. We could pause it for hours on it. But when it comes to putting some sort of constructive bow on this, either Jeremy, you're kind of the idea guy, ideas that you think would be good. Brian, you're kind of from like a practical perspective, what is feasible. Brian, what put a bow on this a little bit.
Oh, you went so great. So in the span of 2 minutes or so, I'm going to have to just give you the
I'll give you
final answer on what to do with Fannie and Freddie and housing finance policy.
Let's give people some.
Look, it's working pretty well. It's working pretty well, right? there are gaps. There are people that are not served by this. It's maybe as good as it can be. Do we need the federal guarantee? Do we need to be on the hook? How does it play into the overall debt situation for the country, which I still think is a major problem? And Fannie and Freddie right now, hey, they're producing money for the government. As theoretically, it should be reducing our debt. So I don't know. I mean, if you asked me as a practical matter, what should we do? I'd say keep muddling along.
And I think that Fannie and Freddie do have a path to exit. I think exit is actually rational and reasonable to achieve in the next couple of years. But I think it requires showing shareholders how the things that Fannie and Freddie are going to invest in are going to dramatically fuel the engine of housing and therefore the economy. And they're not doing that today, as you stated at the outset, and they need to show that they can do that. A couple of ways in which I think they could show that they do that: they are very good insurance companies. So they can be the backer for things like new housing supply financing, because if you de-risk construction, if you de-risk renovation, if you de-risk building, people will do it. And so you can do that with both supply side and demand side financial products that they're already approved to do. They can do construction lending, they can do renovation lending. They should do it in a more direct and feasible way to drive that engine. Two, they can actually look at first-time home buyers with new data in new ways, to Brian's point, to spark the private market. They don't do that. They have the capacity to look at cash flow. They should be looking at it more. They have the ability to hold back funds in a rainy day fund or a safe fund instead of forcing those into a down payment. They're not doing that. So there are things that are true innovation that they know about, they're thinking about, that are either on a shelf or being contemplated by the people within the GSEs. They need to be fueled faster and more aggressively to convince shareholders there's a value here. And then I think it actually is a picture where a shareholder fund could go, I can get behind that. I could see how that engine benefits the rest of my business, benefits the national economy, and they could get to exit. That is a massive undertaking: storytelling, investor relations, and credit independence.
How do you get from privatizing companies, getting them outside of the regulatory environment, to they're going to be doing all these things to help these niche areas to help consumers and the overall national economy? I mean, if they're privatized, they're just doing what they're going to do to make the most money, right? I mean,
well, I was saying that I thought the regulator would always be the regulator. They're never going to not have a regulator. It's just whether the regulator dictates their strategic plans, their pricing, and their offerings. And so what I was suggesting was you can have a scenario where they have a prudential regulator for the safety and soundness that you're talking about that doesn't look into this other stuff. And then, of course, it would become a profit maximizing machine. I think you can also, though, do the implicit guarantee, the structure, in a way where the regulator does actually help guide those opportunities, because you can still price those and subsidize those in various ways. There's still funding that could go to creating these programs. I don't think they have to be subsidized. I'm just saying, like, the regulator doesn't go away. The regulator just becomes a different type of regulator, similar to how banking, insurance, and others. It'll be more active than those, but those are kind of the corollaries.
We should remember too that regardless of your political affiliation, regardless of what administration is in DC, there's a lot of really smart heads in the room that don't want to completely upend the bedrock of the American financial system and want a good path forward for both Fannie and Freddie, for the larger housing industry, for America. Jeremy looks skeptical on that, but that's where we're going to end today's call. What, Jeremy?
This is a great conversation, and it warrants a round two sometime as this develops, because we know it will. So really appreciate it, Robbie. Good to see you, Brian.
Yeah, good to see you guys.
Today's economic calendar kicked off with May producer prices and weekly jobless claims. Much like yesterday's consumer price index, U.S. producer prices increased less than forecast in May, rising 2.6% year over year, though inflationary pressures are still mild. Later today, the Treasury auction will announce the auction sizes for next week's reopened 20-year bonds and 5-year TIPS auctions before actually auctioning $22 billion of reopened 30-year bonds. Freddie Mac will release the primary mortgage market survey for the week ending June 12th, with the prior week's 30 and 15-year mortgage rates both falling 4 basis points, 6.85% and 5.99% respectively. Today looks like it could be another quiet day rate-wise, with agency MBS prices about unchanged from Wednesday's close, the 2-year yielding 3.93%, and the 10-year yielding 4.39% after closing yesterday at 4.41%. Let's wrap up with a joke and some housekeeping. I'm still trying to get my head around the fact that takeout can mean food, dating, or murder. Thanks again to Fly Homes, the leading wholesale lender for buy before you sell solutions. Whether your borrowers run into DTI issues, need to unlock home equity for down payment, make a stronger cash-like offer, or even move potentially with no cash out of pocket, Fly Homes provides a full suite of financial products to help them move forward before selling their current home.